start by introducing myself. I am Richard Gebe. I am lecturing at the University of Sierra Leone at the Institute of Public Administration and Management. I do lecture accounting and finance modules. I want to take this opportunity to make series of video lectures on almost all modules I'm lecturing at the university for students or anybody out there who might find them useful. So in this lecture today, we are looking at financial management, FM, or it can be F9. I want to make it available to every student out there, especially for my plus 600 students who, for one reason or the other, due to circumstances beyond their controls, are not able to attend a class. They can always come here and have these videos useful, and they'll be able to revise, and also will be able to have them useful in and out of the classroom. So you all, this is for you. All I will ask in return is not something that is going to cost you anything. It's for you to just help me subscribe to my channel. You like the videos, you comment, and also share so that you will be able to help this video to reach a wider audience as possible, especially those in need. So thank you as you stay tight. Today we are going to look at financial management. Okay. So in financial management, we want to look at the course outline. So the course outline, first we have our topics, the topics that we are going to look at. We want to start by looking at capital investment appraisal. Okay. Capital investment appraisal. And two, we want to look at weighted average cost of capital. Which you can call WAC. Okay. Three, we want to look at sources of finance or business finance. Four, we want to look at risk management. Risk management. Five, we want to look at business valuation. Five, we want to look at business valuation. And six, we are going to look at working capital management. Okay, we want to look at working capital management, and we want to look at some other sub areas, which will be one, these are just theories, just theory. One, it will be the impact of fintech on finance. Two, we're going to look at macro and microeconomics. And three, lastly, we're going to look at Islamic finance. We're going to look at Islamic finance. Okay, Islamic finance, we're going to look at that one. So basically, these are the topics that we're going to cover. But before we go further, before we look at these topics, briefly, I want to let us look at financial management. What is financial management? Okay, let us look at financial management, the definition, and what financial management is about. So we'll be starting by defining financial management, the definition of financial management. Okay, so what is financial management? We can say it has to do with the strategic planning, directing, and controlling of a business's financial resource that has to do with informed decision making when it comes to funding, when it comes to investing in assets, and balancing risk and return for the sustainability growth of a business. So that can be the definition of financial management. Having known the definition of financial management, we are looking at topics in financial management in our class today. These are the topics, main topics in financial management we are going to cover. As you know, this will have to do with series of video lectures, and today I want to introduce these topics to you, and in our subsequent classes, definitely you're going to expect series of videos coming up on these lectures. So now, our first topic we have is capital investment appraisal. We want to, before we, in the definition of financial management, we want to make informed decisions. So if you want to make an informed decision for investing in any asset or taking any business venture, you want to calculate exactly what is going to be the return on that investment so that you can make decision. So in investment appraisal, we want to check, we want to use different techniques in assessing every investment there and to see what will be the return to the business, if it will be beneficial or not. And we have our decision rules that we are going to look at. Okay, so we want to check here, we are going to check investment. We want to check investment. We want to check investment using various techniques. Okay, using various techniques. These techniques, shortly you're going to discover these techniques. So hold on tight. and also weighted average cost of capital. Here we want to know exactly what is going to be the cost of every fund we want to secure out there to whatever means or source. What will be the cost on us? You know, no one gives out capital for free. There is not such a thing called free lunch, as the economics may say. Okay, so we want to check how much will that capital, what will be the cost on us. Okay, what will be the cost on us? We want to check that. Okay, how about sources of um, finance or business finance? We want to at least get the best source. Okay, best source, the one that will be in the one that will be in the business's benefit. Okay, so we want to get the best source. Okay, so that is best source. You definitely, you need money for your business, but there are some channels you don't want to go through because they will cost you much. So you want to get the best source that will be good for your business. How about risk management? Here we want to look at currency risk. Currency risk. Okay, how to hedge against different risks for the profitability of the business. How to hedge, especially when you are receiving money from abroad or making payment. Okay, receipt and payment. There is this fear that you receiving a certain amount from abroad. There's this fear that there's a risk that the foreign currency might depreciate, or there is a risk that when you're doing a payment abroad, there is a risk that at a particular time that foreign currency might appreciate. Okay, the interest rate might be different. So you want to see how you can hedge against these risks. Okay, how about business valuation? You When you think about takeovers or mergers, you want to value a business using different methodologies in valuing a business. So if you want to value a business, for what purpose? Maybe you are selling a business, or you want to buy a business, you want to take over a business, you want to know the worth of that business. So you can look at whether the market value, you can look at how much you should pay for this business, or how much somebody should pay you for that business. So here we are going to look at series of methods, be it calculation and everything, how we can value a business. Okay, so about working capital management. Working capital management. Okay, here you want to look at how you can manage your operations, your day-to-day operations of your business. So here you want to say, you want to look at current assets minus current liabilities, which will give you your working capital management. You want to look at how to manage receivables, how to manage payables, and also cash management, how you can manage cash. And basically here now we want to look at these are the main topics we should look at and we must look at. And in minor topics, we want to look at the impact of financial technology. Okay, fintech for short. Financial technology on finance, how technology has been able to impact finance in our current world. How about macro and microeconomics. We want to look at policies. As you all know, we have fiscal and monetary policies. We want to look at these things. Okay, policies, we want to look at them. How about Islamic finance? Here we are looking at how the Muslims or how Islam do look at interest and how they can be able to bring and how they are able to bring different means of doing a business without looking at interest, as the interest in this religion, having interest on money can be something else, can be sinful to the Islamic person. So we're able to look at their different um, ways how they are able to do business and different terminologies. So we are going to look at that one here. So this is the introduction of financial management. So first, we want to start our main topic, capital investment appraisal. So if you like, you can even copy, pause, and just copy as you go forward. And I'll give you time for all that one. So, so having looked at the definition, we want to start capital investment appraisal. That is going to be topic number one to start with. So I might say it's CIA. Okay, capital investment appraisal, CIA. So we'll start by asking ourselves, what is capital investment appraisal? Okay, what is capital investment appraisal? What is capital investment appraisal? So here, is greater, we can say is higher. So we want to evaluate whether an investment opportunity is feasible or not. Okay, an investment opportunity is feasible if the investment is lower than the returns, okay, or the returns are higher than what the investment. And on the other hand, again, it is not feasible if what the investment is higher than the return. In looking at capital investment appraisal, these are some of the steps in investment. We can see 6 steps in investment. So these are the processes of capital investment appraisal. Processes of CIA, capital investment appraisal. One, we can say forecast capital requirements. Okay, forecast capital requirement. Two, we can say identify suitable projects. Identify suitable projects. Three, three can be check all projects. You check all projects. Four can be choose the best one. You choose the best one. Five, you invest, make investment. And after making investment, what you do, you monitor. You monitor. Okay? Monitor the investment. You monitor the investment. Okay? You monitor the investment. So we have again processes of capital investment appraisal. Before we invest, we want to take a look at 6 processes before we decide to invest. We just don't invest like that, okay, because we have the money and we just invest. No, we have to go through these processes. And number one process is to forecast capital requirement. One, two, again, to identify suitable projects. When we identify those suitable projects we want to invest in. We we go to the third, we check all projects. We check them to see whether they are uh, having much returns or not, whether they are suitable for our business need or not. So after checking them, we choose or select the best one that we know that it has something beneficial for the business. Then we can make investment. After making the investment, what do? We we just don't leave it like that. We monitor all throughout. Okay, so let us take notes on these steps. Okay, let us take note on these steps. Let's look at each one at a time. So one, we're going to say forecast capital requirements. So here at this stage, companies in this stage, companies
But also we have to edit it.
a regular basis. So, yes. So, yes, about our 6 stages, remember these 6 stages or 6 steps about 6 processes about capital investment appraisal. We look at the 6 steps. We have basically 6 steps, 1 to 6. We forecast capital requirement, identify suitable project, check all projects, choose the best project, make investment, monitor the investment. Okay, so looking at those ones, and here we have brief notes on them. Here we have brief notes on these ones on them. Okay, first we say what we forecast capital requirement. In forecasting capital requirement, we want to see how much fund is required in order for the business to run its day-to-day operations, which we can say working capital management, and how much fund is spared. So, having seen how much fund is spared, then definitely that is the spare fund we need for any investment. We must not use the fund that we need for our working capital management to invest in any other business, because suppose that business goes bad, what will happen? Then we might not be able to manage our day-to-day operations. That one will lead the company to collapse. Okay, so to avoid that, we always forecast our capital requirement, know the excess fund that is already there. Okay, so after having that excess fund, then we can go to our next step, which is what? Or our next stage, which is what? Identify suitable project. We identify suitable project. After receiving information about the spare fund we already have that is available to us, what will happen? We try to look for suitable projects that fit within that spare fund we have. Okay, if we have $10 million, then the spare fund is $10 million, then the project requires $10 million, then it's okay, we invest in it. But if there is any other project requiring more than that amount we have, we must not invest in that project. That is not a suitable project for that time being. So you find suitable project within which what or under the range of such fund available, the fund that we have available. Another one, you check all projects. Here in checking all projects, what do we do in checking all projects? The identified project, remember, we already identified a suitable project. The identified projects are then checked through different investment appraisal techniques. Okay, using different investment appraisal techniques. After checking them, after checking these investment appraisal, after using these investment appraisal techniques in checking, we might be able to know if the project is profitable or not, or if it required our effort. If it requires our effort, then we can invest in it. But if it does not, then it means it is not suitable. Okay, so the fourth step is to choose the best project. After our check-ins and everything, we send it to management. So upon management's approval, we exactly inject. Okay, we inject the right amount of money needed in it. We inject the right amount of money needed in it, which is what? The fifth stage. Upon receiving management approval, the available funds are then injected into the project. We choose the best project and send it to management approval. Then fifth, now we go and invest. So sixth, after investing, you want to monitor the project. You want to see how everything is being done. If you are sticking to your plan and everything, you just don't want to leave it like that, because what will happen? The investment might go bad without proper auditing, and that one will not be good for the business. So basically, these are six stages of investment. So in our class, we want to look at basically this topic one. This lecture one is focused on checking all projects, checking all projects. Okay, so copy this one, then we proceed with the class. Okay, you are done copying. Let's proceed. So let's proceed. Let's start with, so in investment appraisal, we have four ways of how we can check every project. Four techniques. Okay, these techniques we are going to look at thoroughly in this class. So is called technique number one is called net present value. Net present value. That is technique number one. Technique number two is called internal rate of returns. What's technique number three? Technique number three is called return on capital employed. Return on capital employed. Return on capital employed. And fourth, we are going to look at payback period. Payback period. Okay. So in technique number one, we are saying, in looking at technique number one, net present value, this technique number one, we are saying net present value. This is the present value of all future outflows. Now, it is saying present value of all returns, future outflows, less what? Initial investment. Okay, this is the formula for it, less initial investment. What is the rule? There's a rule here. Whenever you calculate an NPV, whenever you calculate an NPV, what will happen? If the NPV is positive, this is positive. If the NPV is what? Positive, then accept the project. Remember, the formula for it is present values of all returns, of all future returns. That's the present value, less initial investment. If the NPV is positive, accept the project. On the other hand, if the NPV is negative, you have to what? Reject or decline the project. That stands. So let us look at examples. Some examples I give to you in class. Let us look at these examples. Don't mind my line, it's very crooked. Just let's look at this example. So now we have an investment. We have what? An investment. We have an investment requiring a project requiring an investment of $4,000. It will generate $2,000 in the first year, and in the second year $3,000, and in the last year, the third year, $1,000. The rate is what? 10%. Find the NPV. Find the NPV. So to start with, always make a table. Okay, doing an NPV question, always make a table. How many years you have? 3 years. But always investment start with at year zero. Okay, investment start when? At year zero. So you make that table. You're going to say, let's look at our solution. Solution will be year 0, 1, 2, 3. Okay, so here we have initial investment. Here we have what? The investment. What is the investment? The investment is 4,000. 4,000. It has to be in bracket because you're making investment. Money is going out. So for cash outflow, you have to negate it. Okay? You have to what? Negate it. It will generate. What will be the revenue? It will generate what? So revenue in year one will be what? What will be the revenue in year one? It's $2,000. $2,000. Revenue in year two will be $3,000. Revenue in year three will be $1,000. Revenue in year three will be what? $1,000. Will be $1,000. So you have these ones. Is there any expense? Or are there any expenses? No. So your next step should be to find the net cash flow, NCF, if there is no tax or whatever. So net cash flow. What's the net cash flow? 4,000 still here, 2,000, 3,000, and 1,000. Okay, and 1,000, and 1,000. So the next step, you bring your discounting factor, DF, which is 10%. Discounting factor, which is what? 10%. What's your discounting factor? 10%. So 10%, you look at the table. Remember, I have taught you how to read this table, and also I've taught you the manual way of uh, this using finding discounting factor, be it present value, discounting factor, or annuity, or perpetuity. You know exactly how to find them. Okay, so currently we are looking at present value. We said in our class 8 1 plus r raised to the power minus n, or we can say what? 1 divided by 1 plus r still raised to the power n, whichever you take. So for example, we are looking at the first year, year 1. Year 1 was the rate 10%. So the first year one, 10%, you got to say 1 divided by what? 1 plus 10% to be 10%. 1 plus 10% raised to the power 1 because it's the first year. Or you can say 1 plus 10% will be 1.1 raised to the power minus 1. So when you solve this one, it will give you 0.909. But you not be required, in the exam, you not be required to solve all these ones. You just have to know the calculation. So the moment you go year 2, just change the power to 2, the power to 2, 3, 4, and so on. So you have the discounting factor. So the table will be available to you. All you need to do, just read the table. The At the horizontal axis, running from left, from uh, right, from left to right, you have the rate, and at the vertical axis, you have the period. So for year 1 at rate 10, go to year 1 at rate 10, you see 0.909. So you have here 0.909. And year 2, you have 0.826. At year 3, you have 0.751. Yes, you have this one in your table. So you check them, you have your line. The next thing is to find your present value. What will be your present value? Multiply 2000 by 0.90. You multiply it. When you multiply it using your calculator, what will be the answer? 2000 multiplied by 0.909, you have 1818. Here you have 1818. But remember, a discounting factor at year 0 is always what? 1. Okay, at year 0, yes, it's always 1. So you bring the worth of the investment down again. When you multiply the worth of the investment by 1, it's also 1. Okay, so here you have 1818. Another one, when you multiply 3000 by 0.826, you have 2472, 2472, 2472. And when you multiply 1000 by 0.751, you're going to get 751. Okay, so if you're going to look for your NPV now, your NPV will be NPV will be what you have to do in finding your NPV. Remember, our rule here is saying present value of all returns. What's the present value of all returns? These are the present values of all returns. You add them and you less initial investment. Okay, you less what? Initial investment. So when we do that, you're able to get, you add and subtract by the initial investment, you're able to get 1041 $1041. It's going to be what? Positive. So what is your rule? You're going to accept the project. Accept the project. This is example 1. Take notes so that we can look at example 2. Take note, we can look at example 2. Maybe it's clear here. So for example 2, let us look at example 2. A project costing $600,000. A project will give $200,000 in year one, $100,000 So this is our example 2. A project costing $600,000. Okay, $6,000 will generate. A project costing $6,000 will give $2,000 in year one, $1,000 in year two, $1,500 in year three, and $2,000 in year four. Interest rate is 12%. Find the NPV. So basically, the first thing you do in finding NPV, don't forget, always your solution. Always do your table. How many years? You have 4 years, but remember investment starts when? At year zero. 0, 1, 2, 3, and 4 years. This is what you have. What is your investment? Initial investment is what? Investment is $600,000. What is your return? So your revenue, year one will be what? $2,000. Year two will be what? Year two will be what? Year one will be $2,000. Excuse me for my dollar sign. I hope the dollar will not get annoyed with me. So year two will be $2,000. Year two will be $1,000. Year three will be $1,500, and year four will be what? $2,000 again. Okay, year four will be $2,000 again. So you have these ones. Your next step, if there is no expense, you just have your net cash flow, NCF, net cash flow. So here you maintain the $6,000, you bring your $2,000, you bring your $1,000, you bring your $1,500, and you bring your $2,000 again. Here, this time around, our discounting factor is 12%. So DF, discounting factor is what? 12%. So you go to your table, your discounting factor for 12%, you go to your table, remember, you go to your table, your discounting factor for 12% at year one, at year zero, definitely year, you know that it's always zero, it's always one. But when you go to year one, discounting factor for 12% on your present value table is what? 0.893. 0.893. You go to year two, the discounting factor for year two is what? The discounting factor for year two is what? One. Use the table. Use the table. Just want to check something. Your discounting factor for year two is 0.797. 0.797 seems very, let me write it better. The discounting factor for year two is what? 0.797. 0.797. And your discounting factor for year three, 0.712. And your discounting factor for year four is 0.636. Yes, you have these discounting factors. Remember how we got the discounting factors? The table will be available even on your financial management textbooks, the recommended learning textbooks you need to consider. I will recommend Kaplan and so many others they are out there, which is recommended. Those ones in the first pages, you have these formulas, you have the discounting factors as well, so you can use that one. Remember, I've made that available to you in class as well. So thank you. Let's continue. Let's proceed. So now you have your present values. Your present values here, PV. This is PV. Here is still going to be 6,000 standing here. How about 2,000 multiplied by 0.893? What will that give to you? 2,000 is going to give you 1786. 1786. And here 1,000 multiplied by 0.797 is going to give you definitely 797. Here 1,500 is going to give you 10 10 8 1068. 1068. Here it's going to give you 1272. Yes. So when you calculate those ones, remember this 6,000 is cash outflow, so it always has to be negated. Okay, it's a negative sign, a negative number. And what will be your NPV? NPV, don't forget, our NPV is saying we always add the outflows first. Just all about math. You add the outflows first, then you later take away the no, sorry, you add the inflows first, the inflows, then later you take away what? The outflow. Good. So when you do all those ones, what will be left with you? Remember, it's going to be 0.1077 negative. What does that signify? Meaning our investment is greater than these ones. Remember, you add this is going to be, when you add all of these ones, the total of it is lower than this one. So the difference is a negative cash outflow. What will happen? What will be your decision? Here you say what? You eject the project. You eject the project. Yes, you eject the project. So take note. Let us look at another example. Take note. Let us look at another example. Don't forget to like, you share, you comment, and also subscribe to the channel so that everyone in need of this module will be able to get information on it, get this lecture. Thank you. So, okay, you're done copying. Let's look at one more example for this class today. One more example. One more example. One more example. One more example for this class. One more example. So it's going to be example number 3. So example number 3. Example 3. Now, example 3 is saying a project. Okay, just take note. Don't mind my lines. It's they are very crooked. I'm learning to write on this new system. So project costing we generate. Okay. In year 2. In year 2. will be scrap for $2,000 is much. We'll take we'll take so a project costing $10,000 will generate $3,000 in year one, $2,000 in year two, and $6,000 in year three. At the end of the project, the machine of the project will be scrapped for $500. Interest rate is 8%, fine NPV. As always, we can say solution. Always finding NPV, you know the number of years and knowing that investment starts when? At year zero. So you do your table. Always do your table. At year zero, you say 0, 1, 2, 3. In 3 years, just 3 years, okay? 3 years. So if we just have 3 years, let us get enough space. Enough space. 3 years, having enough space. Good. You say 0, 1, 2, and 3. So initial investment. What is our initial investment? Our initial investment is what? $10,000. $10,000. Our returns revenue. Our revenue in year one will be what? Revenue in year one. Remember, revenue in year one, it's $3,000. It's $3,000. Revenue in year two, $2,000. $2,000. Revenue in year three, it's $6,000. $6,000. Okay, revenue in year three, it's $6,000. Now, what is your net cash flow? What is your net cash flow? Remember, here before going to get a net cash flow, remember there is also another cash flow there, which is scrap. The machine was scrap for what? $500. So you bring it. When you sell a machine, money is coming in. So because money is coming in, it is cash inflow. Okay, so scrap value of machine, scrap value of machine at the end of the project is what? It's $500. So now to get your net cash flow, you need all of the totals of this one. Net cash flows. $10,000 in bracket, you have $3,000. $3,000. You have $2,000. You have $6,500. Remember the scrap for. Sorry, you don't have to negate these ones. Okay, you don't have to negate these ones. The revenues doesn't have to be negated. Don't, they are not expenses, so you always have to keep them positive, except there is a cost that is higher than what? The return. So remember, keep them positive. This is $3,000. Let me write it clearly so that you can see it. $3,000. $3,000. $3,000. So now these are what your net cash flows. Your next step is your discounting factor. What is it? 8%. Remember in the question, you have a discounting factor of 8%. Okay, your 8% is your discounting factor. Look at it here. This is your discounting factor. You have dealt with all of these ones, and now you just need to get your discounting factor. At year zero is always 1. Remember, don't forget, at year zero, discounting factor is always what? 1. So go to your table. Discounting factor for year year 1 at 8%. Go to your table. On your table, you have 0. So since we have a negative present value, what will happen? We reject the project. So yes, we reject the project. Thank you for today's lecture. Kindly like, you share, you subscribe, and also don't forget to comment so that you'll be able to help this video to reach the right people. I love you. Stay tight. In our next class, we are going to look at some other problems with different approaches. So thank you so much.